Despite its reputation as a safe haven asset, gold is actually down from Friday, despite the Middle East violence. Let's get more from Daniel Ghali, Director of Commodities Strategy at TD Securities. Daniel, great to see you. Now, I know the US dollar has moved up, and that's always tough on gold, but it does seem surprising that gold's still stuck barely above 5,140 right now.
Yeah, absolutely. I'd say a lot of people are surprised about the market reaction in gold, but more broadly across assets as well. And I think one way that we explain that is that we have to account for the fact that quant funds in particular have become one of the dominant participants in commodities markets in particular, and very meaningful across different asset classes as well. And what we think happens in an event like this one, which is a stagflationary shock, that means a shock that is detrimental to growth and to the inflation outlook, but argues for higher inflation as well. The diversification benefits that are typically offered by asset classes starts to deteriorate. And simultaneously, because this is a war, the volatility outlook improves. And that's a recipe that results in a deleveraging for quant funds. This is mechanical in nature, mostly.
And so you said quant funds have become a bigger player in commodities.
Absolutely. I think that's been the case since the last bear market. Quant funds overwhelmingly explain the variation in money manager flows participating in commodities markets today.
Let's have a look at copper, because there's an interesting dynamic there. Maybe a 1 year. The Middle East is a big source of sulfur, and that's an important mineral for producing copper. So this Strait of Hormuz blockage, or virtual blockage, it's just having spreading effects.
Yeah, absolutely. And you had a great guest earlier who was going through some of the dislocations that have occurred as a result of the blockages in the Strait of Hormuz. But the thing to remember here is that the Strait is really consequential for global supply chains. And so what we're starting to see, even just a few days into the war, is a ripple effect across the raw material space. We've seen nickel supply being disrupted. We think copper supply could also potentially be disrupted as a result of sulfur flows as well. So really, this is the mechanism that can start to be inflationary.
And now, what is your view on the U.S., the Fed? Like a surge in energy prices is inflationary. I know it's not quite that simple, but would that be enough to get the Fed to defer interest rate cuts?
Yeah, well, that's an interesting question, right? And goes back to the market reaction in gold. Historically, the conventional thinking has been that a central bank will tend to look through a war impact. But the history has actually been far less conventional than that. And if you really look into it, you find that in every war in which a reserve currency nation has been involved, it's tended to be associated with a pivot from their central bank. And so there are these macro dynamics at play here. Rates markets have already priced out more than half of an interest rate cut before year end. And so there are these follow-through effects that have also hampered the gold outlook.
What about food? Because, of course, this could make food production harder if crucial nitrogen fertilizer shipments are disrupted.
That's true. And, again, going back to the Strait of Hormuz and how important it is, fertilizers, a large proportion of fertilizers have to pass through it. The same is true for LNG. The same is true for the Middle East's food security as well. Grains, seeds, soft commodities as well. The impact cannot be understated.
Daniel, thank you very much indeed. Really appreciate it.
Thank you, Andy. Always a pleasure.
Daniel Ghali, Director of Commodity Strategy at TD Securities.